Hello guys, happy to see you here. And today I would like to discuss the internal controls, of course, and how they are basically helping us to make our processes better, but also how we can sell it as a very good improvement point to the management. We all know that the second and the third lines dancing with tambourines, trying to prove our added value, trying to show that we actually very much needed to the organization, that we're bringing so much added value. But nevertheless, we're staying as a cost center and we are always considered as a pain in the ass, basically. Recently, I left a post in LinkedIn where I was considering the two companies, Walmart and Toyota, who basically grown due to the controls because they implemented the controls. And the very good example is practically Walmart, who grown to that size. Of course, they have a very different a business model, the price, the acquisition, but there is a very, very important inherited element of percent review and the control and continuous monitoring of the inventory. So it's about the segregation of duties. So that's became like a basis and a foundation of this company where they started seeing a growth. And of course, we might argue and challenge that assumption that, okay, without the good business model, without the good management, perhaps that would never happen and the controls just became an additional add-on. But I would argue back that without those controls, the company would not demonstrate that flexibility and that level of success factor, right? So I divided today this point into 4 buckets. So the bucket number 1, that the controls in reality can improve your margin and your cash. And it's always, for me at least, it's always very, very difficult to justify in a dollar bill that the controls are very important. This is not a bottleneck. This is not an additional add-on. This is not a bureaucracy, another layer of bureaucracy. Even though sometimes it is, but in reality, if we're looking into this holistically, then we would notice that it might improve your margin and the cost and the cash, and of course your cost structure. Again, coming back to this very famous example of Walmart, where the founders initially were very keen to monitor the inventory and scrutinizing that from the control perspective, scrutinizing that from the three-way match, scrutinizing that from the segregation of duties. So that was non-negotiable. And that's where we see the great tone at the top. They roll it out, and of course, the control was successful, and of course, it demonstrated the value. So sometimes we are thinking why the controls are not working as they intended, why the compliance is not successful enough, why we cannot convert it into the money. But in major parts that there is no clear tone at the top, then of course the implementation is very weak. And of course this controls just leaves as another ticking point. This kind of control never would be added value, never. So therefore, this is a kind of loop. So there is no, tone at the top, no interest from the management, and of course the control is weak. And then of course it's not added value, and then we are arguing around this. But if there is a tone at the top is right, the implementation would be of course correct. Then it will be the continuous monitoring, which of course would be impacting positively entire ecosystem. So it makes total sense. So why next time you will be talking to your executive management or your subject matter expert or your control performance risk owners, whoever you are talking to, I would definitely use the Walmart as an example. and basically would say, okay, how inventory controls helped them, what it was practically, how it was improving the margin in cash. So the clear control around your stock, allowing you do not overspend and do not allow you to over order, which is of course directly impacting your cash. The turnover is right, you are using the real data, considering that you're using the correct data, that you are monitoring it, that you're looking into this. Time to time, you are challenging the data. So we are reducing the shrink, overstocking, stock outs. Then we have, of course, better gross margins and less working capital lost in your stock. That's the number one, right? So segregation of duties, this is so much important because the first what is coming to my mind is fraud, the commitment of fraud. Basically, if we're discussing about the inventory, that is, of course, it's a physical theft. It's also the inventory that's never reached your warehouse, and it's only on paper. So the physical count is not equal to your what is in your ERP, what is in your system. And of course, then you would have a lot of surprises. In reality, when the management is saying to me that there are a lot of surprises in accounting, then I would always think about the lack of segregation of duties. Because if the one person is doing everything or can override or can make intentional or unintentional mistake, also due to the fraud, you would have a surprise for sure. And then, of course, it will be the direct impact on your P&L if there is a loss, if there is some misconduct, etc., etc. Maybe the probability, we would argue with the probability around this, okay, it never happened, it's not going to happen, but this is a worst risk management ever I have ever heard. So yeah, we don't speak about this. And of course, the three-way match, that also Walmart was thinking about this a lot. And of course, the system, ERP system, was enabling that. So the three-way match, it's a very fundamental. And perhaps as a compliance professional, you absolutely know that this is no-go. This is deal breaker if there is no three-way match, because it's a duplicate invoices, it's a wrong fraudulent payments, it's a misstatement in the stock, it's wrong movement, it's missed invoices, it's some fine and penalties from vendors because you never recorded the invoice, or there are invoices that been duplicated, as I already mentioned, or they were simply missed, they were never even logged, etc., etc. And in reality, here, I would not only think from that risk, but also I would think from the perspective that if you do have a three-way match, you are somehow saving yourself from yourself, right? This is the main goal of the internal controls and the governance and the compliance. So you don't need then to monitor a lot. So you don't need to do these detective checks, which we know this is the worst control ever, because the detective checks are very expensive from the staff time. They are very difficult to fix. We need to make sure that this three-way match is embedded, and it's also saving a lot of the staff time. Even though in the beginning companies tend to say, oh, it's just we need to go through all these steps, and it just increase the time of, we are not flexible, we're not agile, blah blah. But in reality, it's a short-term hit. Yes, I agree, maybe it will felt like this, but then in the long term, even mid-term, you will see the difference. Then the number two, as a bucket number two, as I said, I'm going to talk about this four. The number two, it's we can increase the reliability and the scalability of the organization. So in this case, I would definitely refer to the Toyota case. So perhaps we all know that the Toyota principles, they became as a framework, lean framework. Every production company, more or less, is dreaming to be like Toyota, right? It's a golden rule. It's in reality the best framework that we could imagine. Of course, as any framework has got the pros and cons, and sometimes it's difficult to apply it to different cultures, to different organizations, but all in all, it's a gold. Of course, in this lean framework, the main idea is to make the process very fast, but on the other hand, it's also very much controllable from the quality perspective and, of course, traceable. From the audit perspective, it's great because we can see the audit trail. What does it mean in the application of this methodology? It means that it's a control itself, right? It means that you need to have a clear, again, segregation of every step within the process. So basically, we're looking into the process, not like end to end, but we're looking into the different buckets, different chunks that are happening within this end-to-end process. Why it is important to segregate, to separate, because it's a different accountability, it's a different time, it's a different controls narratives, right? It's something that you need to constantly follow and have the trace, because if something happened wrongly throughout this process and something gets stuck due to the whatever reasons, so then they can come back and look and fix, then the process would be lean. So what is the lean? It's a control itself, right? It's a continuous review of entire process, making sure that everything works well, and nothing works well without the proper segregation of duties. Nothing works well. It could work faster, yes, but nothing works well. So you can basically, sometimes if we don't have the clear segregation of duties, if we don't have a clear description of the process and what is happening in every stage, who is doing what, then you basically do not have a lean process, and you don't have the control and oversight around this. So it will increase the scalability and your reliability through these controls. And it's not just controls of reconciliation, some checks, some unnecessary paperwork. It is exactly looking at the control embedded, like compliance by design, internal controls by design, embedding them into the process itself. And the greatest example is a segregation of duties, some workflows. And then it will not stop entire process, so it will continue, flag it in somehow. If one transaction didn't went well, it doesn't stop entire bunch of the transactions. It's just flagging it to the human who needs to review, but it's very clearly. And imagine if there is no segregation of duties, if there is no process described, then the human can override or do something wrongly, or just we have a newcomer who never have done it before, and then we have a problem because the person is handling it wrongly. Again, we need to save ourselves from ourselves, and the system needs to work. And of course, we as a compliance professionals need to ensure that the process is still explained as it is. It works efficiently and effectively. And effectiveness and efficiency, it is not about adding new controls. It's about ensuring that the process still works as it is intended, where we can reduce some of the, let's say, the duration, where we can add more automation, etc., etc. So you're looking at this as a process, and the controls in the parallel. It is absolutely synergy between these two. The number 3, it's a controls that controls that enabling faster and better decisions. And here you again might argue saying, this is again kind of compliance bullshit. We just say, oh, everything is increasing the faster decisions, and we cannot convert it into the value add, we cannot convert it into the KPI. What does it mean, the better and faster decision? It's like a consultant selling deck. So yeah, it might sound like this, but I would argue again, so if we have a clear visibility on the process, coming back to the point number 2, it does reduce the friction. So if we have information that's structured, framed, coming to the correct stakeholder, flagging in to the correct stakeholder, having a clear parameters when and how it should be reported, and what are the rules in this regards, and it should be of course automated, but if it's not, then everyone knows that this is the things that should be following this kind of framework, then we would have the right decision at the right level. Like small things that could be handled by the lower authority would never be flagged to the higher authority, and other way around. We would definitely see these anomalies and deviations handled at the right level. And what does it mean? So coming back to Toyota that I said, so let's assume we have a lean production process, right? And then all of a sudden, based on the review of all this transaction and the processes, you could definitely see that one sub-process, one part of this end-to-end process is working not like as intended, or there are constant mistakes, or I don't know, like some notifications that are sending over to the human who needs to deal with that. Therefore, the entire process is being slowed down, or it is becoming inefficient, that we need to engage more and more people who need to look into the logs. And then we are somehow not servicing the process, we're servicing the control, which shouldn't be the case, right? But then this information and the review would give you understanding, okay, there is something is wrong over there, so we need to take the decision. And then this problem will reach the right authority level, right stakeholder, right ownership. And then we can fix it, maybe remove some fraction, some, to fine-tune here, fine-tune there, and then it's still working as a process. But it is the control environment and the process governance, it's the whole system. You cannot just look into the small part. You need to consider it as a whole. So that's why it's pretty difficult to explain, but it is holistically, it's a very good way of looking at this. So for instance, then if we would say that we have an approval limits which are not aligned with our risk appetite, or the approval limits, they are not designated to the right level, then again, the wrong decision, they are not scalable, they are not on time. In this case, we're not adding the new decisions, new meetings, new activities. We're basically streamlining through that. And again, the best example, it's some notifications, approvals, limit, workflows that need to work based on your authority level, based on your risk appetite, based on the correct stakeholder in the loop. And then you would be very much happy. And the fourth, the controls, they protect your reputation and license to operate. And here I would definitely argue that this is the truth. And we saw so many bad examples where the companies lost not only their image, not only CFO, CEO went to jail, but it also ruined completely the brand. So you name it. I would not talk about this, this Enron, False Cargo, and all other companies that we definitely know also in the past, the current times. And we basically, in this regard, the governance, the controls is working for the future. So that's why it's very difficult to justify right here, right now, because, okay, maybe we would never face the problem with losing the license to operate. And especially for the companies who are not operating in the very regulated environments like financial sector. So there is no like a regulator, like a central bank who can come and take your license out. So you always have this business continuity risk. But the business continuity risk is relevant to any organization in reality, and we always need to think about it, at least from the enterprise risk management perspective. So what Walmart, again, coming back, what Walmart have done, so what they did, they embedded continuous audits that they were embedded at least into the major processes such as inventory. And it's also about the continuous training and awareness. Again, I'm not reinventing the wheel, I'm saying basic things, but it's important to remember. Then, of course, if you have the clear governance of guardrails, and you can have a different models, like more centralized, decentralized, depending on your business model, but you still need to have kinda boundaries based on your risk appetite, where you say, okay, that's how we work and that's how we're adhering to those standards. If there is no standard, there is no way for you to explain why did it happen. For instance, if you don't have a let's say the process of monitoring your dependency on the key vendors or key customers, and you are not monitoring it on a, you're not just putting it to the deck about the enterprise risk management, but you're really doing something about this, it will definitely at least cover your ass as a CFO or CEO when your board will be asking, okay, what have you done from that perspective? And if there is nothing had been done, we know these examples when the executives been scrutinized, let me put this way. And then, of course, you can also have a better dialogue with your board, with your audit committees, with your investors, when you have some kind of narratives to follow, and it could be super control risk avoided, it could be less risk avoided, but there should be some kind of guardrails that you need to follow, and the boundaries that you need to establish for yourself. And yes, the boundaries don't look and sound right, but this is something that we definitely need to establish. It is protecting your reputation and license to operate. As a compliance professionals, we always need to remember about this. We always need to remind to our executives, to our middle management, that we are here to multiply the assets. We are here to make sure that the company is successful, that there is a business continuity risk is monitored, is taken into the account. And whatever we do, and if we do something wrongly, the small thing like, I don't know, clicking some link in your phishing could destroy your company. It's what's called butterfly effect, which is very much relevant in this regard. So remember these 4 points, like controls improve in reality your margin in cash. The second, then they increase reliability and scalability. The third, controls enable faster, better decisions. Maybe not always faster, but at least better. And controls protect your reputation and license to operate, and make sure that your business continuity risk is taken care. So this is what I wanted to say, and I would be welcoming your examples, and maybe you are curious to hear about the other successful stories, and just check out the Walmart and the Toyota examples and my post that I left in LinkedIn. So I posted it in LinkedIn. So just let's stay connected in LinkedIn, and I'm welcoming your comments, notes, expectations, etc. So see you around.